Coming up today, stocks close higher every day this week. What caused AI trade to bounce? Is the Fed going to cut 25 or 50 basis points this Wednesday? And are we setting up a repeat of 2007? Why isn't the media reporting on gold and Bitcoin? Is the West on the verge of war with Russia? And other building threats to the US dollar. You don't want to miss this one, guys. Let's go. And a warm welcome back, everybody, to this Friday the 13th session on Wall Street. Wasn't really a spooky one, though. In fact, we just put in the 5th consecutive higher daily close this week. Pretty much doing a U-turn from last week, in which we got the worst week in over a year. Markets bounced right back. S&P 500 now within 50 points of an all-time high. Currently sitting above 5,600. And it's an interesting setup because we're right on the cusp of the start of the Fed easing cycle, where it's almost guaranteed the Fed is going to start cutting interest rates this Wednesday. Market's still not sure whether they're going to go 25 or 50 basis points. They're going to cut by 1/4 or 0.5%. And stick with me today because I'll show you how this setup is eerily similar to that of back in September 2007, when the Fed did a 50 basis point cut and the market rallied up afterwards, only for it to top out before one of the worst bear markets of our lifetime. And so I'll show you what the Fed said in their statement back then. We'll also take a look at the US dollar and some implications coming out of that. Gold also made another all-time high today. However, financial media is not really reporting on it, not really talking about Bitcoin either. And I'll show you their homepages a bit later on in this video. Ukraine could also be on the cusp of getting approval to use US long-range weapons inside of Russia. Interesting timing, isn't it? In which Putin's shot back, that may just pull America and the West, along with all of NATO, into the war. We'll take a look at that later on. And just as a reminder, if you're into trading and investing and want to stay up to date on everything that's happening on a daily basis, then subscribe to this channel, and these daily market review videos will show up in your feed every day. And as always, a huge shout out to my loyal viewers. Some of you who have been with me right from the start early last year. I really do appreciate you guys and hitting that like button every day as well. All right, without any further ado, let's dive right in and I'll break down everything important that's happening for you today and give you the bird's eye view across financial markets. So pretty good day in breadth. S&P 500 equal weight almost doubled the return of the market cap weighted. Almost up 1% today, pushing against highs. And it was mega cap tech, although we had a good bounce to start the week, especially on that reversal Wednesday we had. They were a little soft here today. NASDAQ equal weight doing a lot better. And then once again, we can see that broadening breadth with mid caps trading up 1.7% today, doing the best. And giving my stock picks paid members and myself a really nice bump in our portfolios today was the Russell 2000 up almost 2.5%. And it's kind of interesting just looking at the spread of the Russell versus S&P 500, small caps versus large caps. They had been weak pretty much all of August. Then they fell again after the debate, but seemed to find a bit of a bottom there on Wednesday. Had a pretty nice bounce today, almost 2% outperformance of small caps versus large caps. And we got a nice bump up in the amount of stocks hitting new 52-week highs today after that come off the last couple of weeks. I'll also be touching on government bond yields, what the market is implying the Fed's going to do this coming Wednesday. Markets are kind of really at a crossroads here. Start of a new easing cycle. And whether J-Power cuts by 1/4 point or 0.5 point can have big implications on the market and forward returns, just looking back in history. And like I said, we're going to be talking about the US dollar, why that's really under threat, along with the financial media not really reporting on US dollar alternatives, like Bitcoin reclaiming its 50-day VWAP today. And once again, the big fella, gold, breaking out. Brand new all-time highs. $2,610 US dollars per ounce of gold. And if I just invert this chart upside down, there's another way to look at it. The US dollar's value in the eyes of gold. Once again, curious timing. With the US dollar getting demolished in gold's eyes, again, going into the election. And I'll show you the big financial media homepages later that don't seem to be reporting on this for some reason. So again, thanks for everybody who's tuning in with me today and supports independent financial journalism. I don't have an elitist agenda to stick to. I can freely speak my mind. And my job is to bring you closer to the truth and what's actually happening out there, just not what the mainstream media narrative wants you to believe. And so there's a look at the heat map from today. See, it was a bit checkered, overall pretty bullish. But like I just showed you guys, it was more to do with the small caps and mid caps. It was a bit of a defensive rotation. Utilities doing well there today. Financials the weakest sector this week, and mega cap tech was a little flat there today. However, just switching the heat map over to the 1 week performance, just looking at how the markets performed this week, you can see even though it was a bit of a bullish breadth of a move this week, like I said, a big U-turn from last week's move, actually got a bit of weakness in defensive stocks. Energy and oil and gas, which has been the weakest sector for a few months now, still soft this week, and financials, which had been on a tear up until a couple of weeks ago, also pulled back a bit this week. However, what's really bounced back is the AI trade. You can see that with semiconductors Chip stocks, Nvidia slapping on 15%, Microsoft bouncing 7% thanks to some really positive rhetoric coming from Oracle founder Larry Ellison, saying that AI boom's a lot bigger than what we all think, and the market certainly seemed to like that a lot. And it's been something I'd been looking for since semis had been very weak and diverging from the market. We'd had that kind of persistent defensive rotation going on into utilities, staples, also REITs and financials. Now we're seeing some pretty nice bounces in Nvidia, Supermicro, Broadcom, Oracle. After Larry Ellison said any real player in the AI space needs to spend $100 billion minimum to get the compute power. Says they've got 64 data centers. He could see that exploding to 1,000. He thinks that'll justify the investment. And we also heard Jensen Huang come out and push back on that narrative that there's simply no ROI on that huge CapEx spend on AI, and said you'll actually get 10 times savings in the long run, as you can reduce the computing time by about 20 times, and that's allowing a lot of businesses to drive more productivity and efficiencies across the board, both at the front and back end of their businesses. And just interesting looking at some data here called an AI antidote stocks, a list of the most negatively correlated and least correlated to the bespoke AI basket of stocks. It's on the left. This is the list of the most negatively correlated stocks to a basket of AI stock. You can see their defensive stocks, General Mills, Campbell Soup, and others like Industrials, Lockheed Martin, and a few utilities. The lowest absolute correlation, again, mostly defensive stuff, healthcare, staples, and then just zooming in on the chart down the bottom, starting from September last year, in the green line, basket of AI stocks, dark blue line, the most negative correlated stocks to those AI stocks, and in the light blue line, the lowest correlation. And this is what we've been talking about over the last couple of months. We can see that huge outperformance of AI stocks from September last year all the way up until just 2 months ago, July. Had a really big pullback. At the same time, stocks most negatively correlated to them had a big jump, and that's been that rotation out of the AI stocks into defensive stocks. And what we're looking for now and trying to determine, is this just a healthy pullback in an otherwise secular bull market and trend, or is this the start of something new, a defensive rotation that could potentially be the start of a bigger correction in the market? Who knows, a bear market, recession, and this could go on for years. And so that's why we're paying attention to the AI sector, looking for key support, and whether those stocks can break out and take out all-time highs. A lot of people have said Nvidia's already topped after we got that big bearish engulfing candle on the 20th of June, in which it hit $140 a share. And I mean, it's not hard to see why they're calling that. Just looking at a monthly chart of Nvidia, it is definitely stretched here. However, like I always say, value and price is in the eye of the beholder, because if you just switch that chart to logarithmic, some people might say the secular bull market and trend is still intact and it's just taking a bit of a breather here. And just looking at my fundamental chart of Nvidia, my stock fair value indicator currently got it just under $90 a share as being fair value. However, that's just a crude look at the numbers and analyst expectations going forward. It doesn't look at brand strength, monopoly, and all that. So I'd say it well and truly deserves a 32% fair value premium. All other factors look pretty good as well. Positive shareholder yield. And then just looking at my fundamental trends chart layout, you can see that momentum in revenue, cash flow, EPS estimates all trending to the upside. I've also just created a new custom indicator, earnings yield premium. Looks at the earnings yield of a company and takes away the yield of short-term government bonds. Currently at negative 1.8, which again I'd say is fair and justified. Obviously, the income in Nvidia is growing a lot faster than the income from government bonds. And once again, we can see on my trend candles indicator, it's been in a really smooth uptrend since the start of last year. And at the end of the day, markets can do crazy things. Just because it's got a PE of 55 doesn't mean it's hit the top. May get like Cisco in 2000, get a PE of 200. And so I, for one, wouldn't be surprised if Nvidia makes it to 5 trillion market cap in this bull market. But just getting back to the stock market as a whole for the here and now, we are just about to enter the worst 2-week period seasonally of the year, and that's the last 2 weeks of September, which on average bring us negative returns of about 0.7% on the downside. Another interesting stat for you today is that looking at S&P 500 returns on the day of the week, going back almost 100 years, interesting to see that Mondays on average finish down more than they finish up, with negative annualized returns as well. The only day of the week that brings negative annualized returns. The best day being Wednesday, Friday not too far behind it as well. And so if you're like me and do weekly dollar cost averaging into the market, I always do that on a Monday, and it's always better to buy when prices are lower, not higher. And so just like the economy, we're getting mixed results in amongst sectors as well. Tech and retail, bit of dispersion in results and performance. So even though we just heard really upbeat rhetoric and results from Oracle, helping to give chips a bump up, Adobe went the other way. After we got their earnings, which they came in a little higher than expectations, they gave disappointing current quarter outlook, weak guidance, below analysts' expectations, and the stock fell today 8.5%. Did appear to find some support on a spinning doji here. However, Adobe has been trading a bit heavy all year. In fact, it's still below where it started the year. But there's a look at Oracle, currently trading at all-time highs. Did a massive gap up this morning. On the back of more upgrades from analysts, it sold off into the close, pretty much finishing flat on the day. And there's a look at semis as a whole. Still got a bit of work to do, and we can still be in this consolidation phase that's been going on for over half a year now. And like I said, once again, mixed readings in the economy. We just got consumer sentiment coming today at 4-month highs as inflation is pulling back thanks to the big pullback in commodities the last couple of months. In fact, just looking at the Trueflation website, they've got it currently at 1.06%. That's at a 1-year low. The 1-year high being at 3.34. Inflation's really come down these last few months. We've also seen a little bit of a sharp pullback in shipping rate. Looking at a chart here of container freight costs, with not only the rates coming out of the busiest port in the world, Shanghai, but also a composite chart here in the dark grey, turning down this last month. Although we did see that at the end of Q1 as well, before turning back up. However, nonetheless, that helps out the inflation picture for the here and now. Jay Powell could have permission to go ahead with a 50 basis point cut. I'd say it all depends on what he sees right around the corner. If he's got an indication that the jobs market is about to fall off real hard, unemployment's about to spike, he may just rush to get ahead of it. We've got CPI coming in this week. Pretty much in line as expected, a little hotter in core inflation month over month. And even though economic data is not really screaming at us right now to do a 50 basis point cut, just looking at the price action in short-term government bond yields is pretty much doing that. Seen absolute nosedive in the 2-year, and it's actually been doing that since late May when it peaked out. As usual, the market's in front of the Fed. The Fed usually chases the 2-year yield around. Now down at 358, we're almost approaching 2 full percentage points below where the Fed funds rate is, 525 to 550. It's an incredible gap, in fact the largest gap ever. So bond yields wouldn't be surprised at all if Jay Powell cuts 50 basis points. And in fact, Fed fund futures have firmed their odds considerably the last couple of days that they will go 50 basis points, almost at a 50-50 now. And I'd say those short-term bond yields trading so heavy, it's also bringing down the probabilities of Fed fund futures. And so I had been at about 80-20. However, the price action in the bond market is just too hard to ignore. Jay Powell could very well start off by cutting interest rates 0.5%. And so I'm not sure I'd give it 45% chance. However, I think it's reasonable to say there's at least 30% chance or so that he could go 50. However, at this stage, I still think the odds favor a 25 basis point cut, and he can still trim another 50 basis points before the end of the year as they meet again in November and just prior to Christmas as well. However, Fed fund futures, just like the bond market, saying we could have over 100 basis points done by then. Incredible. And so this current setup is eerily similar and reminds me of exactly 17 years ago in September 2007. At that time, I was working for an investment bank, and there was certainly plenty of warning signs back then. I remember a CEO sending out a note warning of the risks in subprime mortgages, the housing market, US consumer looking vulnerable, and the Fed started off their rate cutting cycle back then with 50 basis points, and the market's actually ripped up. They enjoyed it. And even though we have some similarities, as always, there's key differences. Banks were much more leveraged back then, much more risk-taking. Proprietary trading desks, some of them levered 30 to 1, so banks are much more conservative and well managed these days. Household debt, including margin debt in the stock market, was at record highs, which we're not currently at. Yet all those low doc or no doc mortgages, people buying second, third, fourth houses, so a bit of a bubble in the real estate market, along with the subprime mortgage market that was securitized. Basically, they thought bundling low credit quality loans with A and B rated credit quality loans would take away the risk. However, when your yield on those securities is 4 or 5% a year, all it takes 10, 15, 20% of the market to blow up. And since it's all done with leverage, that's how a lot of funds, hedge funds and banks all around the world blew up with it. Financial sector came off more than 80%. 100-year-old Wall Street bank getting liquidated. I remember it vividly. It was a real time of worry, like the whole financial system was melting down. Then the US government came out and got underneath it, which I'm sure a few of you remember, their TARP program. $750 billion of taxpayers' money, pretty much bailing out the financial system, banks, Wall Street. Millions of people losing their jobs and homes. Not a single Wall Street banker sent to jail, of which a lot of people still criticize to this day. And so let's just retrace those steps a little bit, looking at the Fed's moves. In the bull market prior to that, started hiking rates in June 2004, 1.25. Hiked them a bit over a dozen times to mid-06. Got up to 525, which, like I said, eerily similarities to where we are today. Pretty much the same level. And then again, in another similarity to this time, Fed finished hiking in July last year. They did in June 06, a bit over a year later. just like now in September. They got pretty nervous what they were seeing in the housing market and started with 50 basis points. Went again on October 25 and December, and I'll never forget this on January. I was skiing in Breckenridge, Colorado, and I remember coming back to the hotel and seeing the Fed had just cut 75 basis points. Markets were melting down. They went again with an emergency cut, 50 basis points, a bit over a week later. It was all happening. I remember just thinking all those risks in real estate we'd been talking about in 2007, it was just starting to materialize right in front of my eyes. And of course, this went on for almost another year. Really kind of didn't peak out until September, October 2008, once Lehman and Bear Stearns went under. That was kind of the pinnacle of it all. But anyway, just looking back at when they started, September 18, 2007. Let's go take a look on the charts. Okay, here we are looking at the SPY. S&P500 ETF. First ever ETF created actually in 1993. Now has over $500 billion assets under management. Anyway, here's the daily chart back in 2007. Again, kind of eerily similar setup. Market was rallying really well all the way up until July. Kind of peeled back a bit. Got this big bottom and hammer formation on the 16th of August. We got ours on the 5th of August. Rallied up just like we are now. And there's the 18th of September. When the Fed cut 50 basis points. And then the market went on to rally, but it was less than a month later on the 11th of October, and kind of this bearish engulfing candle we got here. The market made its top for this bull market that kicked off March 2003. And then I remember this period as well. We were weak going right into year end. And I remember back then, a lot of us already knew about the Santa Claus rally. It was well known back then. A lot of us were hoping for the Santa Claus rally, were banking on it, and then it just didn't materialize. And I remember talking with my mates back at the bank then and saying this is the most seasonally bullish period time of the year, and just look at how the market's trading, just super soft and weak. Then there's January, back when the Fed did those big emergency cuts. Market was just getting created. Pretty much held this downtrend all of 2008. A lot of people were thinking we bottomed there, pulled back. We bounced back somewhat into mid-year, only to roll over again, hard into July, consolidated again somewhat, and then the real panic set in, like I said, in September, October. Lehman Brothers, Bear Stearns kind of blew up the financial system. Fed and government had to step in, and the markets just kept sliding and sliding. Tried to find a bottom. Again, looked like the market had bottomed. Bounced up a bit going into 09, and then just took out those lows, and that was the bottom of the bear market. March 2009. And I remember this day here as well. Citigroup came out and beat expectations, or gave some updated guidance that they're making more money than what the analysts were expecting them to. And I remember that day, markets bounced really hard and they pretty much never looked back. 2009 ended up being a great year. And so here we are now on the cusp of a Fed rate cutting cycle. Is 2007 and hopefully not 2008 going to play out the same again? The only question is, what's the big risk in the market? Because yeah, we do have lofty valuations. However, we don't have the risks with the banks and subprime mortgages. There is some risks in commercial real estate. However, that already looks well contained. I'm interested to hear your thoughts as always. You're welcome to drop a comment below this video and let me know what you think could be the reason this time for markets to really roll over. What sort of catalysts are out there? And could it be something different this time? But remember, if the Fed does cut 50 basis points, typically that doesn't bode well for forward stock returns, because that kind of implies they see something really bad out there, where 25 basis points could be more thought of as a soft cut, and that typically bodes well forward stock returns. And there's a look at the Fed statement when they kicked it off in September. You're welcome to pause your video player if you want to take a read of that. But they basically just acknowledged tightening of credit conditions and the potential to intensify the housing correction. As usual, they weren't really forecasting anything too bad. Now, just moving on to a topic I've been talking a little bit about lately, and you won't really hear a whole lot about it across mainstream financial media, and that's the sharply decreasing value of the US dollar, with some significant headwinds going forward, namely federal government spending. Just looking at a line chart here of the 6-month moving average, in which they're already under a lot of criticism in the years leading up to 2020, the growing amount of spending and deficit. However, 2020 just took it to a whole new level, and it's continued on in that time as well. And like Charlie Ballio pointed out today, the US government continues to spend money like a drunken sailor, with a budget deficit of $2 trillion over the past year. This is occurring when the economy is still in an expansion and home stock prices are at a record high. What happens to the deficit when a recession hits? Implying the government's balance sheet's already blown out in good times. What's going to happen in bad times? We may not have seen the worst of them. In fact, just looking at their receipts and outlays for last month alone, total receipts came in at $307 billion, while their total outlays more than double that, $687 billion. And so just to put these numbers into some context that you and I can relate to, imagine when you're a bit younger and you're making about $307 per week. For how long do you think you could spend $687 per week before all your creditors come calling for you? And that's why I show this meme. You think this train we're on has brakes? Potentially not. So if the US dollar is going to get decimated from the inside and externally, how do us as investors position for that, or at least protect and hedge our wealth? With a lot of us having a significant portion of our wealth denominated in US dollars, well, as I've said for a long time, gold is one of the best places to be, as you're pretty much short the US dollar, but also international stocks. And just looking at this chart here, of the US dollar in the light blue line inverted, see here on the right scale, we're currently just above 100. In the dark blue, the real GDP year over year of the world excluding the US. You can see remarkable correlation. In other words, a weak US dollar is good for other countries and their growth. And that's something I've been doing of late, buying more international shares, which is another way to reduce US dollar exposure. But it's interesting, isn't it? US dollar getting demolished in gold's eyes, breaking up to all-time highs. That should be all over the financial media. But people in the community are starting to notice this. Saw a fund manager today on X said the most unnoticed all-time high ever, #gold. And like someone pointed out, unnoticed or censored. Got another guy today. Today the US dollar fell to an all-time low against real money, gold. Hardly anyone noticed. Crickets. Tumbleweed. Peter Schiff as well. Gold just broke out above 25.80, hitting another record high. Let's see if CNBC even notices. And just looking at the homepage of CNBC today, it doesn't appear so. They think Oracle's Larry Ellison becoming more richer than Jeff Bezos is more relevant. And just scrolling down through their leading headline, nothing about gold, nowhere to be seen. Pretty interesting, isn't it? Same with the Journal, just going through all their leading headlines, nothing about gold. Looking at the homepage of Barron, America's housing crisis isn't going away. How to write it, but once again, nothing about gold. Not a whole lot about Bitcoin either. Markets Insider, once again, nothing about gold. They do have an article, Americans are the richest they've ever been, thanks to soaring real estate and stock prices. However, just keep in mind, averages don't mean a whole lot to people because they're highly skewed by the top 1%. Just because the entire pile of assets has grown doesn't mean it's grown for everybody. But again, scrolling down, nothing about gold, no articles about Bitcoin. That's why you guys come to Click Capital, right? To get the lowdown, to get uncensored media, to get analysis from someone that doesn't have an elitist agenda. And so this is important. Gold ripping up, the US dollar getting created, along with a bit of a bump up in Bitcoin as well. And this is coming at a time when not only has the government blown out their debt over the last couple of years, even though the economy's been expanding, perfect time to decrease their debt. We've also seen the most significant rise and expansion of BRICS in the last couple of years. It was initially just Brazil, Russia, India, and China. Now it's expanded. Almost half the world's population. South Africa, Iran, Egypt, Ethiopia, Saudi Arabia, UAE. BRICS headed up by China and Russia, with them saying another 34 countries have expressed desire to join, with potentially others like Turkey and Thailand looking to switch sides as well. So this multipolar world looks to be going more in the direction of BRICS. The current US-led Western Alliance is losing power and influence on the global stage. And they're going to have their big BRICS summit in Russia next month, with Xi Jinping scheduled to attend as well, where they'll be looking to take the global stage, outline policy, invite more countries to join them, and potentially kick off their new payment system, which they say has already got 159 participants. Again, another big threat to the US dollar. All these guys determined to get off it, as the US government's been criticized of overplaying their leverage when it comes to sanctions. And again, just adds to the desire of these central banks getting their reserves into gold. And now it's expected that Blinken will announce tomorrow the US has given Ukraine the green light to strike deep inside Russia using Western-made Storm Shadow missile. Just after we heard that the current president apparently working on Ukraine using US long-range weapons inside Russia. But I don't know about you guys, but that sounds to me like he's trying to poke the bear. And is he the one making this really important decision for pretty much the entire world at this stage? And again, curious timing, isn't it? We're seeing a real provocation from the West towards Russia right in front of an election. And it's not just the States either. We've got the UK Prime Minister saying he also supports Ukraine using long-range missiles to strike inside Russia. However, not all Europeans are on board with this. We've even got a high-ranking Polish politician telling Antony Blinken, go home as soon as possible, get lost, we don't want you here, we don't want Polish people paying and dying for your wars. And so does anybody really think with the West permitting Ukraine to use Western weapons to strike deep within Russia, that Putin's just going to sit there and take it on the chin? Is he bluffing this time when he says that if that does happen, the US, the West, NATO will be pulled directly into a war with Russia? He may start striking outside of Ukraine. Is this the path to world peace? Or would it be better to potentially negotiate this war away, which Putin's showing willingness and readiness to do? However, it seems the current admin wants things to dial up as they potentially hand over the torch to someone else. Just looking at crude oil markets, they're not really worried. It's more a narrative of weakening demand, like the International Energy Agency's been forecasting. Record supply, soft China, all of that seems to be dominating the price of oil here and now. Did find support midweek, $65 a barrel. It's really gold. It may have a bit of a geopolitical risk premium getting built into it, as it pretty much has done all year and the last couple of years, as we have the worst geopolitical setup of our lifetime. And just rounding out news today, and something else that's not been acknowledged from the current admin, kind of underreported as well, but is pretty significant. We just saw SpaceX mission crew complete the first ever commercial spacewalk. A 4-person crew of civilians stepped outside their capsule and made history as the first group of non-government astronauts to conduct a spacewalk. By venturing further into space than anyone has since the Apollo program 50 years ago, the crew set another milestone in space travel. And so space as an industry is growing fast. There is some companies listed on the market at the moment. Rocket Lab being one of them. It's been ripping up really well of late. However, the SpaceX IPO could still be a few years off, but we may get a big run in stocks like this going into it. And so this is a stock I find really interesting. Although not cheap, it does have growing revenue, and they help to launch space satellites as well and other launch services. It's really kind of interesting time, kind of the resurgence of the space industry led by commercial companies this time instead of NASA. And just getting back into the charts, there's the VIX finishing at a 16 handle on the week. Option dealers still demanding 2 points above realized to sell contracts. High yield bonds breaking out to another yearly high. The dollar trading down again to the bottom of its range, sitting in mid 100s. And against the yen, the dollar is weakening. Actually took out the low 5th of August. The US dollar is sliding not only against gold but other currencies as well. And another sharp move up for silver today. Looking pretty good here. And there's a look at the energy sector. Still trying to find a bottom here. And we were pretty much green across the board. Every sector higher. But like I said, it was small caps that took the lead today. Up 2.5%, reclaiming their 50-day VWAP. And that was a significant outperformance of large caps. We'll see if that can continue into next week. However, next week will be interesting. The first Fed rate cut. They're going to go 25 or 50. Let me know your thoughts. Let me know what you think will be the main culprit of the next bear market. Other than that, thanks for sticking with Click Capital. I hope you enjoyed today's video, and I look forward to breaking it all down again for you next week. Have a good weekend, guys. Cheers.